Guys. So this is Stephen Bird. He's head of the Global Consumer Bank at a little place called Citigroup. I have a couple questions. We have 25 minutes, going to launch into it. First question, it's always surprising to me to hear that, because I'm a New Yorker, there's only 700 branches in the whole US, because in the city, there's 2 on every corner. So if you could please talk a little bit about your strategy, how that's going so far, and what are the metrics we could judge you by?
Well, great to be here. Thank you, Hugh. You're right. We have a light physical, high digital, big brand, big data model. That is our model. Not only in the US, but our business, we have 110 million customers, but globally, we've got a light physical footprint. We're 34 billion in revenues, but we only have 2,400 branches across Asia, US, and Mexico. So that lean physical footprint gives an imperative that we have got to be world-class in digital, that we've got to run an ecosystem of value. That's why we've composed an ecosystem that includes American Airlines, Costco, Home Depot, Best Buy, LL Bean in the US, because we know that our customers are already in the ecosystems, and we want to go to where our customers are. That's the strategy that we follow. Now the branches, high tech, high touch. Customers, we saw it in the prior presentation that our customers want wealth advice. They want personal financial advice. They also want wealth advice. That can be powered by digital. It can be powered by algorithms, but there's also a very important place for face-to-face.
So, to be clear, the post-financial crisis era has been, the story of it has really been that the banks with the broadest, physical network, have been the ones who get a disproportionate share of the deposits. So is this about sort of playing the hand that you're dealt, or is this about some kind of a bet on where behaviors are going in the future?
Well, I use the term about being a 21st century competitor, and we really like the hand that we've got, because what we're interested in, what is the direction of travel? And it's not a blinding insight to say that in the last 10 years, what's happened in the last 10 years is that smart devices, brilliant apps, fast networks, and cloud computing has created what is a new solution stack, not just for financial services, but it's happened in every area of commerce, social engagement, entertainment. So you can think of all of these things as a service. So if you ask yourself, it's true that in this last tightening cycle, that having a large physical network did benefit deposit gathering, and we saw that if you had 4,000 or 5,000 branches in North America, you had superior deposit growth. We are transitioning into a world where the digital ecosystem is far more valuable. A couple of reasons. Let me give you some sort of facts that back that up. So the current forecast is that in the next 3 years, branch traffic will fall by a further 36%, and that mobile transactions will double again. This is in the US. Now, if you go out,
this is not from a Citigroup economist, is it?
No, this is not. This is an external set of stats. Now, our own analysis corroborates that. So in real time, we're measuring these things. But if you go out to markets that have leapfrogged, so say you go out to the Far East. I spent 17 years in Asia, building our business in Asia. I spent the last 7, up until I became the CEO of the Consumer Bank, up until 2015 in Hong Kong. If you go out to the Far East, you'll see that digital ecosystems, the fastest growing financial services providers such as Ant Financial have created a full ecosystem within which you organize your financial life. Cash has albeit disappeared, and that the ability to be pre-approved for credit has become a a standard in the industry. So when you look at the friction that exists in the West today, a lack of real-time payments, particularly the US is very far behind in this. If you look at the fact that most credit is post-approved rather than pre-approved, there's still a lot of friction that customers experience. What we're doing with our model is taking that friction out. That's what we're trying to find a way. And we're using the Far East as a clarion call as to where the world is going.
So, and people should know here, you spent 17 years leading Citi in Asia. That's where that informs a lot of your thoughts. So, if you allow me to oversimplify, cards is your entry point on some level. Cards, that's how I have a relationship with you guys and many others. And so one instance is if you have the 2% cash back, there's a sweetener, it jumps at 2.5. I think it's a targeted offer. I didn't get one, not offended yet. Are people signing up for these? What's the uptake on these? Is it, and the follow-up question is, the worry is, if they're signing up for the ancillary product, which is like a 2.5% savings account, is that hot money? Is that a relationship or is that hot money?
Yeah, let me describe a little bit of that, because perhaps I should have said this at the start. So describe our model as light physical, high digital, high brand. We are the world's largest credit card company. So we're a full 10% larger than JP Morgan Chase globally, because of course we've got Asia and Mexico in addition to the US. We're number 2 in the US. Now that cards business is by far the most digital relationship. In fact, our US cards business is the most digital of all the card providers in terms of engagement with customers. And you are right, it is an entry point. Now, if you think about it, credit cards are a very digital business. It's a payments business. It is loaded with data. So I know everything about you.
Spending habits.
Yeah, I mean, spending habits. I know geolocation habits, where you're spending, how you're spending, when you're spending, acceleration of spending, your credit profile, whether it's improving, deteriorating. But what customers are interested in is, am I using that data to help you? Am I giving you more value? And that's why I describe all the work we put into the ecosystem is so important. So for example, in that cards business, there's $540 billion of spending. So this tribe of customers spend $540 billion a year. Now, what you want to know, and you mentioned, Hugh, that you have the cashback product. You want to know that your money goes further because you're part of that. You're getting the leverage of all of that spending. That's why we do deals with American, deals with Costco, deal with Home Depot, deal with Best Buy. Or out in Asia, we just announced the Grab taxi deal. We just announced the Paytm deal. We do Qantas in Australia. Now, second part of your question. So yes, cards is an entry, and it tends to be a very effective feeder into relationships. Citi is a relationship bank. We are not a monoline. We don't think of ourselves as a monoline. And many fintechs, because they start there, they start with a very narrow solution that they solve, and then they go broader. We're interested in building long-term relationships. So your question about, is it hot money? That's a very good one, because we know that you have chosen, say, double cash, you value cash back. Or you've chosen American Airlines, you value air miles. Or you have prestige and you value thank you points. What we're doing is we are saying, let me allow you to earn that currency across your full relationship. Do you have a salary deposit? Are you getting thank you points for that already if you're somewhere else? Do you have a mortgage with us or somebody else? Why don't you accrue a broader set of benefits by having a relationship? Yeah. Now, it also was in one of the slides earlier that customers want to be able to see everything in one place. I don't want to be able to I go over here, I see a little slice of credit. I go over here, I see how much savings I got. I go over here to brokerage, and I can see how my investments are doing. What I have on my phone, and we developed this after we'd been out to Silicon Valley when I came to the States, is account snapshot, the entire relationship, borrow, pay, save, invest, and protect on the screen. Everything linked, so that I'm getting benefits of every part of it. And we think that that's what the future looks like. If you go out to the Far East and you look at the insane amount of information on a single screen where you can live on your device, where you are, and of course there's a little bit of the density of information you can communicate through kanji characters, etc. That helps small real estate, but we think that same tendency of convenience will be demanded here in the West.
The aesthetic on Asian apps, though, I was shocked at how cluttered they are, or they're dense with these little buttons everywhere. And we have a different aesthetic here, obviously, which is the Google aesthetic, which is...
So we do have a different aesthetic, and it's interesting, though, because I do co-creation sessions with customers. So our mobile app was developed by our own customers. We've had 20,000 co-creation sessions now. And when we first sat with our clients and they said, well, I want to be able to see a full relationship, I want to be able to stop and start my credit card. I want to be able to stop and start my debit card. I want to be able to see not only my FICO score, but the trend of my score. I want to be able to see my relationship manager's face. I want to be able to message a relationship manager. I'd like to have a digital virtual assistant so that, we talk about AI. A digital virtual assistant is effectively you getting through to the single best person you could get through to, who is listening to all of the current communications that are happening. When we were asked to put all that in one place, we initially thought, wouldn't that be really cluttered? It's actually insane how much through good design that you can build in. If you go into the App Store today and you see, I look at it all the time, we're probably 4.8 rated or something today, but I read the verbatims. We have got an incredible amount of value in that app. And because we're updating it in real time, it's improving all the time. So I think that the trend of just how much you can do in your device is going to keep rising for a long time. And especially 5G makes it that, when you can download a Hollywood movie in 3 minutes, there's no bandwidth limit to what you can flow to the device.
So, in the green room, we talked about the end of the cycle. It's going to come someday. You've been through this. You've seen this in your career. I mean, what does your gut tell you about how close that is?
Well, we're late cycle. Now, this cycle's a little bit different from prior ones because when you have a financial crisis, trust is damaged. When trust is damaged and counterparty confidence is hit, it takes much longer to repair. So we had a much longer period of quantitative easing, super low rates, and then we've seen rates go up, and now signaling because of trade wars, et cetera, that the rates will come back down. So in terms of credit expansion, we are late cycle. The fact that the yield curve has gone negative, it has accurately, the yield curve being negative has forecast 9 of the last 5 recessions. So there's a false positive, but it did get the 5. So it's late cycle. What we do is very experienced risk and credit managers is when you know you're late cycle, you manage the composition of your portfolio carefully. You manage your existing customer treatments carefully. You use data in the best possible way. We're doing all of those things, but we are growing our business. So I mentioned, it's a very large business, $34 billion business. You mentioned what are the, how do we know it's working? Well, we are growing the total by about 4%. We're growing the US, we're growing Mexico, we're growing Asia. We've got positive operating leverage, so we're expanding margin.
Sure.
All of that whilst recognizing that we are part of a cycle.
Let's now, this is a good segue. Competitive landscape, you and everybody else are in a battle for deposits, right? This is the fuel of a bank. You have tech giants. We're talking, Amazon, Apple, maybe even Uber, who might go into this. There are new banks like Chime. We had them on earlier today. Marcus at Goldman as well. What does this next phase of banking look like?
Well, the first thing is that I think that a lot of the trends I just described are underestimated. I think we are in an epochal shift. I mean, we're living in a time that is, as humans, we quickly get sort of used to, we've had 10 iPhones now, so we're kind of used to these devices. But we are still in the very formative stages of a completely connected planet. We're in the very formative stages of a direct, digital, data-rich, and you see all the manifestations of that. Initially, nobody's worried about privacy, then everybody's very concerned about privacy. We're learning, and these things are maturing. I think that big tech is coming. It's very clear.
Banking.
So big tech is coming into banking for sure. We talked about, 4 years ago when I came to the States, at that time there was $2 billion a month capital going into fintech. Everybody said, fintech is going to eat the lunch of the big banks. That then matured into a recognition that a lot of those businesses couldn't fund themselves through deposits. There's still no nationwide licensed deposit gatherers within fintech. The fintech players effectively borrow the license of existing banks today to do that. So I think that it's not just fintech. Big tech will bring better client experiences. This is a great time to be a customer. It's a great time to have more choice. Customer expectations are demanding speed and simplicity in everything. As somebody who uses all of these services, I'm the most critical guy in our business. I eat all their own cooking. I'm incredibly demanding of any delays. I'm incredibly demanding of any customer friction. I consider what is happening competitively to be a time of increased competition. That will continue, and it will only be good for consumers.
Now, to fight that, you have, banks, obviously, the result in this country, result of a lot of roll-ups. I had an experience with my own bank, Chase, where I had their auto lease. I have an auto lease with them, I have a car lease, and I have the main checking account. Auto lease was over, and so I owed them like $50. And so I get a letter in the mail, I get words on paper that says I have to write a check to them and send it to Arizona. And to me, I just almost lost it then, because I was like, why isn't this a button somewhere? I have to mail you a check, but you have both of these relationships. It's insane. And this Chase obviously has a pretty good reputation in this space.
Yeah.
I imagine that you have to fight a lot of those kinds of battles. And how do you do that?
So what you just described, we reorganized in the fall of last year exactly because of the issue you just described. So our business in the States had grown up in silos. It had been a credit card business, it had been a retail bank, it had been a mortgage business. And what that does is it creates huge disconnects for our customers. And they tell me this, they email me, they tell me about it. I see the friction. And so what we did is we reorganized that there's a single CEO for North America. We put all of the products together under him. And what he and his team are doing are making, the vision is, I should never ask you for a piece of information that you already gave me. It's a complete insult if I ask you, what's your mother's maiden name? You already told me. You told me for the credit card. You have an existing relationship with me. I know where you live. I know everything else. So why do I do that? So we're not there yet, but we are re-engineering and replumbing to give you that single view, to make it easy that your entire relationship is linked. Because if we don't, we would go extinct. I mean, I say it's an epochal shift. This is dinosaurs are, if you don't change and recognize that the speed of the external environment is such that every customer is intolerant of that type of friction, and I am hypersensitive to it. So we reorganize. So there's a strategy component, there's a technology component, there's a talent component, but structure follows strategy. And if a customer views us as Citi, one place, we got to be organized as one place, and all the tech assets got to flow into the same thing.
So how long before mission accomplished, right? Is it a 2-year plan, 4-year plan, 5-year plan?
So right now, as a Citi client, I say I use everything myself. I have everything on my smartphone, as do tens of millions of others. So we've got the fastest growing mobile base in North America. We also have the fastest growing base.
Faster than Chase and B of A?
Yeah, we've come from a smaller base, but we are growing faster. I describe us as the most improved.
Catching up.
Catching up. We're growing faster than any of the other major banks. We still get significant double-digit growth rates of our mobile users here in this US market. So in terms of when is it, it's a journey. It's not a destination. I am intolerant of any delays on us getting there. We're using a lot of fintech partnerships to get there faster. So we call it fintegration. If you've got a brilliant component that allows us to have a better experience, whether it be biometric recognition, whether it be geolocation, whether it be risk decisioning, then we integrate that into our open banking platform.
So you probably saw this story wherever you were in the world at the time. I reported that you guys had stepped away from the Apple Card negotiations on concerns that about the economics of the deal. What are the chances that you look at this 5-10 years from now and say, we wish we should have done that deal?
Well, certainly I do not underestimate Apple at all. Anybody that can disrupt a telecoms business the way they have, or disrupt the music business that they did, or the retail business. There's multiple vectors, cameras. What I don't underestimate Apple, but I would also point out that though I can't reveal all our third-party discussions, but given who we are as the world's largest credit card issuer, you would expect us to be at the table with all of those big tech guys. Now, what we do is we look at, is it a value proposition that is new and different from what we have? Is it going to add something significant to our portfolio? Because it's about priorities. I can't do everything. I'm already knitting the place together, as I described to you. I've described some of our other partnerships. So, is it possible in the future that we would look back and say, we wish we had been there? It's entirely possible. But the point about profitability, our customers want us to be there in the future. We're a 200-year-old institution, a 207-year-old institution. When you borrow public money, when you take money from the public, they want to know that it's secure, that you're a trusted entity. Part of that mix is, of course, that you're profitable. Yeah. Otherwise, you're not going to have a very long future. So we look at all of those variables. But let's see what happens. Apple, I certainly wouldn't underestimate them.
Fair enough. So we're coming up on time. Let's play the overrated, underrated game, shall we? So I say a word. You tell me if it's under, overrated. Let's start off. Challenger banks, or neobanks, as you like to call them.
Overrated.
Overrated.
I think if you have... You got to look at each territory differently. The UK, because it has been more regulatory open, there has been a bigger movement into the challenger banks, so you need to have some of those market characteristics. The US is still very fragmented, and it's very difficult to be a complete nationwide partner. So if you're a challenger bank and you're having to borrow the bank license of Bancorp or somebody else, that's going to limit how effective you can be. So for the US, I would say overrated, perhaps for Europe, under.
SoFi.
What I would point to there is it looks underrated until you experience a full credit cycle. So any of the lenders, you got to really, it would be foolish to comment until you live through a credit cycle. And I would say that of anybody that's lending.
Last one. I did this before too, in my earlier panel. Marcus by Goldman Sachs.
I would say the same thing in terms of lending. You've got to live through a credit cycle. I mean, I think they've brought some really neat things. We learn from all of those guys. We learn from SoFi, we learn from Marcus, we learn from what Apple is doing. But I would say that as a banker, I would be foolish to give you a judgment until the credit cycle plays through.
Fair enough. So guys, that's our time.
Thank you.